Hey guys, Jay here. This is smarthelping.com. Got a new financial model ready to go. So this is the model here is to buying lots of land and developing them. And I've done many of these scenarios with a lot of different developers. And this is kind of the default model I've come to that I think will fit a lot of different cases. It has very good assumptions to understand the timing of cash in and out using an interest-only loan, as well as situations where you're building and then selling. This is not for building and then renting out. I have other models for that or other models for acquisition, but this is for builders to build and sell and understand all the different timing of that cash flow, the debt. Um, and I've also added on some assumptions if you have a joint venture with a GP-LP structure, and you might have fees with that as and basically I put together an IRR hurdle setup for that monthly and annual conventions so you can see those calculations. But I want to focus first on the operational side of this and how you actually get to what this project will cost, what kind of cash flow it will produce, what kind of returns, and we'll see that on a monthly granularity. Now, it doesn't have three statement modeling. It's not income statement, balance sheet, cash flow statement. It's basically just cash flow. That's the most important thing. And it does have the option for build costs to happen over time, not all up front when the build starts. So it's a smarter spreadsheet in that sense. So let's start. I'll go through every tab, starting with the global control, and I'll explain how it all works. So up top, you have global assumptions. You can enter the start year here. Now, the fiscal years don't really matter for the dates. So don't get too caught up in the fiscal years, like it says here, January, February, March. Main thing, the whole model will run off of the month and number. And basically, this is month one is when the first month things can happen. And then as you enter months in the future, it will drive the expected activities. Uh, and before I get too far, note that the data tab here, this is how you actually enter your lots. So if you're buying lots, you can go, I think I did logic for up to 600, but you could drag the formulas down even further if you want. You just enter data about the lots. So the lot name, status, the month of you expect to sell it. This is all these light gray columns are formulas. You don't need to mess with those. Sales price, you can adjust that as you need. The start month, which will adjust when number one, the land costs are paid, and number two, the build costs begin. Now this build cost is going to be spread out. So the land cost assumes that's paid up whenever the start month happens. That's all up front. But the build cost might happen over time. So here, like this 550,000, we're saying 20% is going to happen in month one, 0% in month two, 20% in month three, 40% in month four until we get to 100%. And then that logic will apply dynamically based on when the start month happens for each lot. And you could, this formula, these work all the way down. You could if you fill more lots in here, you could also fill this in. So it has the ability to dynamically pay for each one, or they might be all on the same schedule, same pattern, that's fine. You can see over the M1 tab, this is where those costs are happening, like I just said. So whenever the start month is entered, you see costs happening here, and each one equals 550,000 because that's the total cost I've put in for all these. And that will dynamically flow to the monthly detail on the total build cost row 12. Um, so and I want to hit on that earlier in the video because that's one of the main features of this model is how the build costs happen. But we have start year, we have average selling cost. This just applies to this every time there's a sale. Right now we're selling them all in month 35. Here there'll just be a selling cost associated if you enter a percentage into here. That's what that cost is. You also have some fees. You might have upfront valuation fees, some cost per draw based on a number of draw count, and that's going to all happen in a defined month here. The valuation fee also going to happen in a defined month, and you can see you define those there. I put month 2. On the monthly detail, you can see those hitting in month 2. Here's the draw fees hitting. Now, and then the upfront valuation fee of 500,000 is happening here in month 2 as well. So those are adjustable. and the amount and when they actually will hit your cash flow, cash requirement. You've also got the loan. So this is only assuming interest only debt. And the loan, you can manually put how much you're going to borrow and when. In this model, month one always assumes this is the first month of the forecast, whatever that is. So if you're not going to draw for a few months, and that will basically just affect the amount of interest that you're going to have to pay, you could put your draws in the future whenever they plan on happening. And then you can manually enter when you're going to pay back that principal. If there is still a balance at the end of the loan term, which you can manually define here right on row 12. So here it's 35. It's being automatically paid back in that month. Now, if you were to pay back some earlier, let's say we wanted to put some down here, it's going to reduce the repayment that happens automatically here. Now, if you pay back more before the term, that's fine. It will just be zeroed out. And let's say I wanted to pay it back here, 3,510,000. That's fine. Now the repayment doesn't automatically happen here because you've paid back the full balance. But you can see as a helper, I put in the bank balance here, which is tracking all cash flows based on the model month number. And it shows you, well, you've actually don't have enough money to pay that back there. You're going to have to wait until we pay back or wait till we sell the properties. You can see there's cash flow from that happening here. And I'm just assuming everything happens in month 35. And then we do our final distributions to investor equity here in month 36 of whatever's left of the cash. We'll get into more of this in a second for distributions, but let's focus here on the loan. So interest only, we got a term. You could manually put in how much you're borrowing and when, and how much you're repaying and when. And if you don't repay all back manually, it will automatically happen at the end of whatever term is defined here. You can define the interest rate, the origination fee, underwriting fees, and then the month number that those fees happen, and that will apply to right here. We have origination fee, underwriting, processing fees happening in these two rows. This all affects cash flow dynamically. So that's the top part. Over here we have cash raised. So this is the amount of equity being injected into the project. If you were to hit 0 right here, then you can see over on the monthly detail, this bank balance row 41 is going to be below 0, meaning this is what the cash, this is how much cash is going to be required to keep the project afloat over time. So if we're not putting any money into it, we have some borrow amounts entered here, but it's not enough, so this is negative. And you never want this to be negative. If this row is negative, it's saying based on your assumptions, you don't think you're going to have enough money to actually do the deal. So that's what the dynamic is there with bank balance. And that's looking at essentially all the cash flows and accumulating them over time, as well as including equity invested. So cash coming into the project as well as accounting for cash going out. So if I were to undo this, put the 4.9 million back in there, you can see I've put in the final month 100%, and this is always taking the cash balance of the previous month, otherwise you'd have a circular reference. So if I put 0, there's now a $7.6 million balance of cash, and this is basically the net profit of the project that's still remaining. You haven't distributed anything. So if I then go put 100% in here, it goes zeros out, and then this is distributed and is available. If you were to do it earlier, well, you can see here before you actually make the sale, there's not a whole lot of cash available. So if I were to put maybe 10% here, it's just distributing 3,000, which is 10% of this balance. And then if I did 100 after, okay. So you can see how this is dynamic. Now, depending on, assuming, let's say you expect to sell your properties over time and not all in 1 month, then it's likely you might want to distribute money to investors. If they have a preferred return or IRR hurdles, you're going to want to get them their money back as fast as possible. So you'll do maybe earlier distributions rather than just at the end, and then that will flow to them, and that will also affect this cash flow balance and the bank balance. You never want that to go below 0 as you're changing these numbers. I think this is pretty innovative and useful. So manually having a distribution row rather than trying to calculate automatically. I think this is something I've had clients do before, and I think it's useful in this case. So essentially for the investors, all that matters is row 54, which is simply summing up the amount that's being distributed against the amount that's been invested. And now the investment amount we have automated a little bit with this schedule here. So this is all cash being invested by equity investors, and then row 54, row 51 is all the money coming back to them, and that's all happening within the context of this bank balance here. So you want to make sure you have enough invested to keep the bank balance above zero and not distributing too much so that the bank balance goes below zero. So you can craft your strategy based on when you think you're going to sell the lots, how much it's going to cost to build them, and all of that stuff is all taken into account here. Okay, and then over here, finally, these are, well, we'll talk about this in a second. Let's stick to the main project. So we've got cash raise, we've got the equity IRR here. So this is just the cash in and out of equity, which is just this row here, 54. This is showing the IRR of that and the equity multiple of this equity. Now you can put more money in here than the minimum cash required here. This is showing you need 4.865 million. You've put in 4.9. That's a net of 34,000 in reserve after all effects, which is basically just the difference of the investment amount against the minimum. You see those match. You could technically make this exactly the same. Let's see, this minimum was 4.7. If I were to put 4.743.329, except for there is an acquisition fee in this case, so it's going to be a little bit more. Okay, now it's saying I need 118,000 more because that's going to cover some fees. So let's say it's 4.861.912. Okay, a little bit more, 4.864.877. And this, again, this little ramping here, I'm getting a smaller amount is just because I have an acquisition fee, which is based on the amount raised. So as you raise that, that fee goes up, and then you have to recalculate. Now, I think it's safest just assuming you're going to have a $100,000 buffer or maybe $200,000 buffer. So if it's saying you need 4.7, maybe put in 5 million, raise 5 million, and now you've got a little bit of reserve. Your minimum bank balance is not below zero, which is good. And that's how you want to think about that within the context of this model. Okay, and then min cash position, min bank balance here is take a minimum of 41. Bank balance, oh, that's just saying zero because we do zero it out here, but you don't want that to be negative is the main thing. And then this is the unleveraged IRR and unleveraged equity multiple. So this is what the IRR and equity multiple is of the project itself, assuming there's no debt used, obviously. So unlevered cash flow. And the reason why that'll be, even if you do no debt, that'll be a little bit different than the equity IRR, even if you invest exactly the amount it says here as the minimum, because this is looking at monthly cash flows and the IRR of those cash flows happening, the negative cash flows are happening over time. They're not happening all up front like when the equity is raised. So you're going to get a little bit of a different internal rate of return. Now the equity multiple will be the same if you make the investments the same. So let's zero out the acquisition fee so I can do this quicker. And it says, okay, we need 4.7 million. If I put that in the investment, you can see now the equity multiple is 1.6 here. It's 1.6 here. It's the same. All right. Now the IRR is going to be different still because, again, this is doing the project cash flows, which have that cash outflow happening in the future. So it's discounted rather than having that cash all up front like in the equity investment. So you're going to get a little bit of a different internal rate of return, but the equity multiple is the same if you do invest exactly the minimum amount of cash you need here. Okay. Then we have just project summary. So your total development and financing costs, build costs, land costs, interest, other fees, net sales proceeds, total proceeds, selling costs. This all balances out. If you start doing the math, you could see the net profit of the project is 2.828. If you go over here to annual detail, we're at 2.828. It's the net cash balance distributed. That's also what's going to be on these IR hurdles, 2.828. 2.828. So that's the same. Total cash flows are the same for all these things. And that is taking your total build costs, land costs, interest expense, other fees. Now, other fees also includes all these fees here, upfront valuation fee, total draw fees, origination underwriting, as well as the acquisition fees here. And then this model, so the client I did this for has a partnership with builders where they get a percentage of the profit. So if you look at the data tab here, I actually do a calculation for each unit because you might have different builders for different units and they have different profit shares. So we're spreading out all the different fees and all the interest evenly across all the units. So that's what this column M is doing. And then we're calculating what the actual profit was on each unit based on, total cost less or total sales price less all the costs here to get a profit. And then the profit share. So some of that percentage might go to your builder rather than paying your builder a set fee. So that happens in column P. So that's what the builder is getting. And then essentially this is the net profit of the owners or operators after they pay all the expenses, they sold all the units, they paid off their builder profit share. This is the profit of the actual project. So that you can see 282,430 matches 282,430 matches this, and that also matches where our final, in this case, is the final cash balance of equity here, 282,828,430. So this is very, very cool. I love all the logic here. It all flows nice. I spent quite a bit of time making sure all this stuff works dynamically because every situation is going to be different as far as the amounts and the timing of this and how many lots you might have. Again, you can do this for up to 500 lots. If you don't use one, you can always clear out data. I also made this protected. If you want to right click and protect, you can protect the sheet. Don't type anything in the password if you don't want and just hit OK. And if you do that, all these columns that have formulas will be protected, meaning you can't change them. So you won't accidentally uh, break any of the formulas. And then all the tabs here, you could change all these non-grayed out columns are fine. You could adjust them to anything. If I say that's 400,000 or whatever, these are all editable still. I'll unprotect that as the base version. Let's see what else. We want a loan, global control, the fees. So the monthly IRR hurdle. This is just an IRR hurdle schedule with 3 hurdles. LPGP setup. You can have some of the cash required coming from the LP versus the GP. In this case, we're saying, well, we need 4.7 million. The LP's coming up with 4.5. The GP's coming up with the rest, 237,000 in this case. And then based on the total return to the LP, we're doing hurdles. So I put in 100% for the LP, 0% for the GP up until a 6% internal rate of return has been achieved by the LP. Now, IRR is not a simple preferred return. That means they've gotten all their money back plus a compounded 6% return. And this model is doing 100%. And then after that, if the GP has got them over 6% hurdle, well, up to 7% is now cash is going to be split 75-25. So the GP is now getting some share of that cash. And then over 7 up to 8, there it's 70-30, and then over 8% IRR for the LP, now it's 50-50. So this incentive structure just says, okay, as a GP, if you can get the LP better returns, you're going to get more and more cash flow, share of the cash flow as the GP. Now you can adjust these. This could be pari passu, meaning you're going to give 5% to the GP, 95% to the LP until the LPs reach this hurdle. You can adjust these as needed. The calculations all happen here for tier 1, tier 2, tier 3. It's all laid out very clearly, and then the bottom shows the summary of each. And you see over here, we're just doing all distributions happening at the end. This is a management fee here, or a disposition fee, but all the actual profit distribution is happening in 1 month based on our current assumptions. And now if they happen over time, that's completely fine. All the logic would work, no problem. But here you can see the distributions at each tier going to the GP and the LP. And in this case, the IRR is 13%, so that we're getting all the way through to the thereafter tier, which is good. Here's equity multiple and IRR for the GP and LP. I did an annual summary of the LP and GP's returns based on that. And I've also done annual IRR hurdles, which should match the monthly, assuming you do all the cash up front, as is happening here. And then you're doing a full 36 months. And notice on the monthly detail or the model, I've ended the cash flow. So you're getting all that cash in month 35 and the final distribution is in month 36. So it all fits in 3 years in this case. So you can see the IRR and equity multiple is 1.48, 13.8%, which is the same as in the monthly convention, 1.44, 13%. Oh wait, nope, slightly different. Wait, did I change something? Oh yeah, I put this at 95.5. So 1.44 and 13, 1.44 and 13, 6.08. Now the IRR for the for the sponsor is going to be a little bit different because of the monthly cash flows, but you can see the total amounts going to each party should be the same in this case. So 1999, 1205. So it's the same. Now this will not be the same if you have contributions happening over time, like not all up front, and if you don't end on an even year, which is okay, that's fine. The monthly is the most accurate, but some people like to see the annual calculations because it's a little bit easier to understand. But the monthly is more accurate. All right, and you don't have to use any of that if you don't want. If you just want to use this for project management to see, plan out cash flows and test different scenarios on pricing, volume, how much cash you're going to have over time based on the debt, that's what model is very good at doing. Alrighty, well that's all I got for you. This is in the real estate bundle at smarthelping.com. So if I go to the home page, go to real estate, I will put this model. It's a new model underwriting template. It'll go into this top section. And I think I'll charge probably $75 one-time fee on it. You can also buy the whole bundle of real estate models for $299, and I've got a lot of different scenarios here for different types of real estate, mobile home parks, mixed use, hotels, assisted living, short-term rentals, strip mall acquisition, single tenant industrial. This one's really good for anything based with units, acquisition, or new development. So a lot of different models to check out. Some base joint venture waterfall logic structures here, and some other things: cost segregation study, cost basis calculator, depreciation recapture analysis. So a lot of good info. $299. And hey, if you want to check out, I've done hundreds of financial models for a bunch of different industries. Um, Over on the right here, you can get the Super Smart Bundle for $4.99, and that includes everything on the entire site. So check it out, and I will see you guys on the next one. Like and subscribe.